country itself is the people. They're pragmatic people. They do what they say. They're very honest. They're being honorable people, and they're hardworking people, and they go for it. They don't want to fail. No one wants to fail, but they're ready to do something. And then if that doesn't work, they close it up, that shop, and try something new.
Good afternoon, everyone, and a warm welcome to our regional seminar, M&A Transactions During COVID-19, with a focus on hospitality, organized and hosted by Hong Kong Business Association Vietnam. We welcome participants in the regions with speakers in Singapore as well as in Ho Chi Minh City. My name is Winnie Lam. I'm the General Secretary for the Hong Kong Business Association in Vietnam and the COO of hteligence International here. I will take you through the program today. I would like to start by thanking our guest speakers, Mr. Giovanni Marino, Managing Director of KPMG Legal Hanoi, Mr. Binh Tran, Director of KPMG Legal Vietnam, Mr. Govinda Singh, Executive Director, hteligence International Asia, and our moderator, Mr. David Jackson, CEO of hteligence International in Vietnam. It is my honor to be hosting you. Thank you. We have 15 national and regional organizations to co-host our event today, and it is evidence that the topic is really hot. Allow me a moment to thank all of them. From the region, Hong Kong Australia Business Association Limited, Hong Kong Chamber of Commerce in China, Hong Kong Singapore Business Association, Hong Kong Trade Development Council, Hong Kong Chamber of Commerce of the Philippines, and in Hong Kong, China Real Estate Chamber of Commerce Hong Kong and International Chapter. And in Vietnam, Australian Chamber of Commerce, BBGV, CanCham, Indian Business Chamber, Malaysian Business Chamber, Singapore Business Group, the Thai Business Association, Central and Eastern European Chamber of Commerce, Italian Chamber of Commerce, and the Council of Taiwanese Chamber of Commerce in Vietnam welcomes all of your members. Today's webinar will consist of 2 presentations and a panel discussion to follow, where you can raise questions throughout the webinars using the Q&A function on your Zoom toolbar at the bottom of your screen. For good housekeeping, the hosts have muted all your microphones and video to ensure focus. Any questions that we cannot get to during the event, we will get back to you later privately. If you've encountered any technical issue during the webinar, our suggestion is for you to log out and log in again. So without further delay, I know there are also more attendants to log in. We're going to get going with the presentation. Let me quickly get Mr. Giovanni Marino and Mr. Binh Tran from KPMG to kickstart their seminar. A very brief introduction of the 2 of them. Mr. Giovanni Marino, Managing Director of KPMG Legal Hanoi, is admitted in Italy and has been based in Asia for 20 years. His practice concentrates on corporate, M&A, and commercial matters, and he has extensive experience in advising European and Asian corporations, financial institutions, and funds on a wide range of cross-border transactions, including the structuring and financing of foreign direct investments, inbound and outbound, M&A, and commercial arrangements. And in his 20 years of activity in the region, Giovanni has advised on transactions including Vietnam, Hong Kong, China, Indonesia, and Thailand, as well as cross-border from Asia to Europe and the US. While Giovanni will start off with the presentation, Mr. Binh Tran will be taking over at some point, who has 13 years of professional experience in legal services with a leading international law firm in Vietnam, with a concentration on M&A, corporate and commercial services, dispute resolution, and intellectual property. Binh earned his BA from Brandeis University and JD from the University of Georgia School of Law. He is admitted to the New York bar and is a registered foreign lawyer in Vietnam. So if Ben and Giovanni, if you are ready, I'm going to hand it over to you to start with the presentation. So Giovanni, you ready to take it over? If you turn on your video so that we can see you, Giovanni and Ben.
Okay. Hold on a minute. Can you see us?
All right, we can see you. Can you host your presentation and then you can take away?
Yes. Share screen. Sorry, we have.
That's okay. It's new for many of us.
It is. And we're just getting used to it.
Okay.
Okay.
All right, you are on. Hand it over to you.
Yes, thank you very much, and thanks for the introduction. As Winnie was explaining, I've been in Asia for over 20 years, with my time spent between Hong Kong and Vietnam. I was in Hong Kong in 2003 during the SARS epidemic, and naturally, when the COVID started in January, I was trying to make sense of it all, comparing it to the days of SARS. Of course, we all know that the reality is now far beyond our initial expectations. The effects are still unknown, and we are now talking of a new reality. As in many other sectors, and in a way more than other sectors, the sector of hospitality has been greatly affected. Low occupancy rate and weak demand in the foreseeable future is impacting on cash flow. Subsequently, also on the valuation of the asset. We are seeing nowadays the valuation of assets with a drop of around 25 or 30%. Pre-COVID, we would see investors looking at deals in hospitality with a valuation of around 11 to 12 times EBITDA, whereas now these prices have dropped to about 8 times and below EBITDA. Although the extent of the crisis is still unclear, the situation is, of course, proving quite favorable for mergers and acquisition opportunities, so that the market is becoming a buyer's market. This observation is also a little bit comforted also from what's happening in China, where we are noticing in recent months a great deal of inbound M&A into the Chinese market. The kind of assets that are mostly sought after are, of course, the hotels and resorts that are situated near tourist destination. The average size of the deal that we see ranges from 15 to 25 million for 4 or 5 stars hotels that are now more affordable than before COVID. The Vietnamese government is obviously trying to support the sectors and the economy in general. One of the measures that has been activated is the deferring the payment of taxes by 5 months. Hospitality falls under one of the eligible business for these incentives, just like foreign investor enterprises can also be included under this scope. There have been also some updates to regulations impacting on the hospitality, as the government now recognizes the status of condo hotels, and appropriate ownership certificate can be issued to Vietnamese national proving ownership. In an effort to reduce unsold inventory, now the Ministry of Construction is proposing to extend this right also to foreigners, which would give a boost to the market. Together with the dynamics in the market, we are now also observing investors slowly adapting to this new situation, with deals that are being negotiated and executed based on provision which are kind of tailored to the scope in terms of valuation, future earnout, material adverse change and termination, as well as deals with a different closing mechanics than pre-COVID. My colleague Bean will dive more into details on this. But from a more general point of view, prospective investors obviously have 2 or 3 different ways of entering the market. The most obvious one is an acquisition, which might be either an equity acquisition or an asset acquisition. Purchase of shares in the company will mean that you will, of course, assume some legal responsibility for the target company, including any liability that the company might have. So a good due diligence exercise is essential, as we all know that in Vietnam there might be certain issues in the company or in the asset that the previous owner had either been unaware or has simply decided to ignore or worse, to conceal. With many businesses in the hospitality industry also suffering from poor cash flow, some operators who will not be normally on the market looking for investors are now in a situation of needing capital injection. This is more often the case in the case of ongoing or partial completed projects. In this case, an option would then be moving forward to extending financing to such operators, perhaps with provision to convert your financing into equity for a certain date or a certain evaluation. You need to take into account that although convertible loans can be enforced, if you are a foreign investor, you need to consider the business lines of the company that is taking the loan. Because if any of these business lines falls out of the permitted activities for foreign investment, there might be any issues in the conversion, or worse, you might not be able to recover the loan if there is a default. As far as the prospective investors are concerned, we have kind of grouped the potential investors in a couple of categories. We are seeing lots of cash-rich buyers. These are investors with large sum of money available that are looking at acquiring assets for a lower evaluation. And these are usually, based on our experience, local investors, which are also more helped by the flexibility in the optional disposal to execute the transaction, as opposed to certain restrictions that are still applicable to foreign investors. Then we have another category that we see, which is entity already on the market, competing on the market, that they are now looking at acquiring similar business to increase the market share or to diversify the portfolio or the target clientele that they cater for. These, in our experience, are either local investors but we are seeing also some interest from regional groups looking at the market. Sorry. Yeah. For the market intelligence, I mean, these investors are now looking at the market with a more careful eye than ever before. I don't want to speak too much on the market positioning or on the knowing your client base. These are obvious elements, but I will spend some more words on the conditions of asset and the potential risk which are commonly encountered on the Vietnamese market. My colleague Bin will speak more in details, but in very general terms, first of all, we have the issue of the land. As we all know, land ownership in Vietnam is different than in any other jurisdiction. is usually granted on the basis of a land use right. In practice, most of the hotel owners are likely to hold the lease over the land for 50 years. It is imperative that the status of the land use right is verified to assess any issue that might affect the validity of it. You also need an assessment around potential extension of the land lease. Payment of premium and taxes should also be addressed early. In addition, certain target investment may sound like a very promising deal, but we recommend extensive due diligence to be performed on the asset in question. The building could be very old, or there might be some hazard that even the previous owner is unaware of, unwilling to deal with. We have encountered often issues where some of the operational licenses and permits, in example, those affecting the fire and the electric system of an asset. These are issues that might be costly to fix and time-consuming to deal with if you don't address this early. On top of it, usually companies do maintain a register of assets, but based on our experience, there has been cases in which the register is not complete, or the title on certain asset is not clear from a legal point of view. So verification of the asset is important to ensure that the acquisition price reflects the valuation that you are discussing with the counterpart. For other details now, I will leave to Bean that will go into more details about the M&A transaction that we've seen happening on the market and how this transaction has been affected by COVID. Thank you very much.
Okay, thank you, Giovanni. And yeah, so thank you for the very sort of helpful macro picture. So my job now is more to provide you with the micro picture, the nitty gritty of actually doing a deal here in Vietnam. And I'll start off with the antitrust issue. This is a relatively new issue in Vietnam. While the competition law has always been there for many years now, there has been a new law and a new implementing decree that I think has caused some difficulties in the M&A market. So obviously, if you're an investor looking to purchase a sizable hotel or a group of hotels, then most likely it will trigger the Vietnamese antitrust law. So you have to know sort of the parameters of that and how to navigate. Okay, so enterprises that participate in economic concentration must notify the National Competition Committee, the NCC, to seek prior approval if it reaches a certain threshold. Joint ventures, obviously mergers, consolidations, acquisitions, all fall within the scope of economic concentration. However, the expanded antitrust regulations now include additional circumstances where antitrust clearance is required, and this is where sort of the more controversial aspect of the law comes into play, such as a deal size being over 1,000 billion dong, which is about equivalent to 43 million US dollars, or if an asset value of the purchaser and buyer are at a certain threshold, or the purchasing or revenue of the parties are at a certain level. So if you're looking to acquire a 5-star hotel, easily you will exceed this threshold. So bear in mind that for the foreseeable future, the antitrust regulations will be in place. So that adds another layer of regulatory approval that you have to take into account in terms of your overall deals timeline. Okay. Moving on to the next part, in terms of pre-negotiation considerations, obviously, if you're looking at hospitality, then the Hotel Management Agreement, the HMA, will be sort of one of the chief agreements that you have to consider. So in Vietnam, it's common for some owners to self-manage, while others choose to offer one of the sort of international brands operators. In such situations, a review of the term of the HMA must be done to avoid inheriting very onerous obligations as the new owner. These agreements could have been entered into decades ago, and I personally seen HMAs that have been entered into close to 30 years ago, and basically a lot of the provisions in there are a bit outdated. Doesn't really reflect the current market or best practices. So you will have to sort of take that into account. For example, whether the operator needs to have an onshore presence. You need to review operating licenses, especially if, say, the hotel has a gaming casino operation. Those are actually critical aspects of the deal to understand beforehand before you actually proceed, because those can be deal breakers. Other clauses to consider in the HMA is obviously the fee structure. Includes the base management fee, the incentive fees, you have booking fees, royalty fees. There are a number of fees in there that, again, was negotiated many years, many decades ago, and now you are inheriting that. So having understanding of the financial obligation in that respect, and whether you can actually revise the HMA to make it reflect current practice, again, that's where sort of your advisors come into play. Aside from that, you also have employment contracts. Again, some of these hotels, they do hire very expensive people, such as the general manager, CFO, chief accountant. So again, understanding what their entitlements are, and to the extent that you're replacing them with other people, having understanding of what your rights are, your obligations are, and basically how much you have to pay at the end of the day. Supplier and service contracts are also important. Usually when you enter into an HMA with an operator, they will actually stipulate that you have to purchase or procure goods from their designated suppliers. Again, with COVID, that is that's a little bit more complicated now with supply chain logistics issues. So again, considering whether you can procure locally or from another supplier that meets the same standards, those are more operational matters that should be taken into account at the very early stage. And then you have data ownership. Data's become more of a global issue, and of course, Vietnam also has regulations on this. Care should be taken that there's compliance with data protection standards, in particular when dealing with suppliers, hotel operators, and especially with online travel agencies, commonly used platform nowadays. Potential buyers will have to pay attention to who owns the books accounts, and more importantly, ownership of guest lists, right? So it's all about data nowadays. And company documents, again, critical because some of these arrangements have been entered into sort of years ago, and they're not always compliant. They're not always compliant with current regulations and best practices, especially if those such agreements were entered into a long time ago with an SOE, state-owned enterprise, which we've seen a lot of as well. So it's important to actually engage advisors at the early stage to understand sort of what's the downside, and also what are the benefits with these company documents, and how we sort of address these issues going forward. Okay, for deals under negotiation, look, speed really depends on sort of the parties, their risk appetite and their willingness to close the transaction. Vietnam is a tourist hotspot, but with the difficulties sort of businesses face, some are desperate for investment or to sell. They would want the deal to proceed as quickly as possible, but again, the speed depends on the principles involved. But there are certain things you can do to actually speed up the process, whether it's expediting due diligence, doing negotiations, transaction documents concurrently. That would actually speed up the timeline. But again, you need to overlay all the regulatory approvals and all those issues, as part of your overall deals timeline. And on that point, we are also seeing a lot of sellers conduct vendor due diligence. Basically, they take it on themselves to hire a firm like KPMG to help them prepare a vendor due diligence report. Basically, our finance, tax, legal team will come into their company and basically prepare a due diligence report, but we call it a vendor due diligence report because we can actually send it out to various investors. They can rely on that report, and basically that saves a lot of time and cost for the vendor, because now you're able to engage with a lot of investors, but not having to go through with the DD process for each one. Of course, as an investor, you will most likely conduct your own confirmatory or top-up due diligence just to confirm that the information in the VDD is indeed accurate, or basically reflect the current situation of the company. Reassessing forecast scenarios and revisiting valuation expectations. Look, I mean, the situation now, you're already seeing that, you know, the end is nowhere in sight, to be honest, and that's an unfortunate thing. We're already seeing the, you know, second wave hitting the US. You're also seeing it in China. So this will ultimately contribute to, you know, the parties having to revisit valuation expectations, most likely from the vendor side. I mean, that's it's just very obvious that they need to make a downward adjustment. Same for the investor. Again, that's why it is a buyer's market. There are a lot of good assets that are you know, available now for acquisition. So that is another sort of consequence of COVID. Okay. So better positions for deals. I think, again, a bit self-serving on my part, but, you know, retaining the right legal, tax, financial advisors early on really shows that the sellers or buyer, you know, there's a willingness on both sides to actually sort of proceed with the deal and to close the deal. And basically having the right team in place will really expedite the overall M&A process. Otherwise, without the right team in place, and I've seen this, you know, if it's just principals talking amongst themselves, you know, the idea that business people can do this, they obviously can, but when it comes down to the contract itself, the nitty gritty, I've seen deals drag out for 1.5 years before they sort of throw up their arms and say, all right, we need advisors to come in and really help facilitate the process. Huh? For obviously, financing and liquidity is a major issue. If you're not self-funded, investors must have the capability to fundraise, as there are uncertain short and medium-term impact of COVID. Obviously, financiers are tightening, you know, disbursements for existing financial arrangements. Even so, we're already seeing that. So if you have a war chest that will better position you, your company to actually do deals, obviously not just in Vietnam, but just globally. Deal strategy for advisors, you know, on the ground here tend to have intimate knowledge of the domestic market, and they'll help you create and refine your deal strategy and negotiation process, again, with the aim of reducing cost and time. You know, for example, if, you know, your deal advisor looking at the overall structure of the target company might advise you to acquire, say, offshore rather than onshore, there might be certain benefits to doing it that way rather than acquiring directly. They might advise you to keep certain financing arrangements with, say, existing shareholders in place, because again, there might be some financial or tax efficiency benefits to keeping those arrangements in place or to pay them off, right? It depends, but with the right advisors, they'll steer you in the right direction. Okay, moving quickly along, and I know we're running out of time. So when considering evaluation, there's a shift from best practice to value creation. The new focus is on profit improvements, as current performance is not a good indicator of future earnings, clearly. So the uncertainty around business performance may now prompt buyers to move away from sort of fixed pricing system, lockbox, to, you know, allow for working capital adjustments to address any unexpected turn in business performance. Again, you know, investors will benefit from market insights from your local advisors. Okay, again, the transaction fundamentals. Vendors are likely to value their company more optimistically and obviously at a higher price than what it is actually worth. Due to COVID, the expectation gap is likely to be even wider. And usually this will be a disputed point, but if the parties sort of reach alignment early on, we can sort of, you know, save a lot of time and costs later on. The timeline for completion, again, I've already touched on this. It really depends on the parties and the willingness, you know, for them to actually proceed with the deal, understanding what is involved in terms of the closing process. As I've already mentioned, there are a slew of regulatory approvals that you need to obtain, whether it's the competition authority approval, the licensing authority's approval, third-party consent, you know, the hotel operator, joint venture partners, et cetera, et cetera. So these are things that, your advisors will help you understand and define, and then that will give you an idea of, what is the timeline most likely for completion. Because as an investor, you want to get in early. Again, for sellers, they may want to exit as soon as possible, needing funds to, shore up their other operations overseas, as we've seen recently as well here in Vietnam. Okay. So the last few slides, I'll just touch on some of the contractual provisions in the SPA, sort of one of the key agreements. So for conditions precedents, they're in place to mitigate your concerns and basically flow from the due diligence findings. Okay. Again, the DD will inform investors in terms of what are the likely conditions present, CPs, and your advisors will then overlay additional CPs based on, basic on their experience and their knowledge of the market. Reps and warranties, again, very important. We've touched upon sort of basically the quality of the assets, again, from a technical perspective. Yes, you have your technical advisors in there to look at the building, the superstructure, to make sure that, it's basically safe, it's up to a certain standard. But obviously, there are also concerns over title. Does the company have title to certain land documents? Especially, does the company have title to the assets on the land? So reps and warranties, again, parties spend a lot of time actually negotiating this. And, reps and warranties, indemnities insurance is actually a new product. Also in Vietnam, I know it's very common in other common law jurisdictions, but in Vietnam, there have been a couple deals where this type of insurance has been sort of put in place, but generally that's not really used. But we're seeing a trend where sort of buyers and sellers are more open to this insurance product. Again, material adverse change, I won't go into a lot of detail on this, but in the context of COVID, this is something that needs to be sort of understood, needs to be negotiated. The back clause, basically when something goes wrong, giving the buyer or the seller the right to walk away from the deal can be heavily negotiated. It really depends on your advisors. A MAC clause can be as short as, a MAC is anything that the buyer considers a MAC. But if you're a seller, you want something more robust, giving it more sort of parameters, definitions in terms of, how much does a loss have to be, a loss of value in something, a loss of profit. You can define the MAC provision to basically suit your purpose. But again, at the end of the day, it's a heavily negotiated provision in an SPA. Also for to manage sort of downside risks, investors can put in place earn-out mechanisms, including holdback amounts, other earn-out mechanisms based on performance, and basically rescission rights, termination of a contract in the worst case scenario. So again, really depends on the company you're looking to acquire, what your advisors are sort of advising you in terms of how to protect sort of any downside risk. But again, all subject to agreement from sellers.
2 more minutes, Ben.
Yep. Okay. So I'll go through quickly. Again, this is I think all of this is pretty self-explanatory. Long stop dates. Again, that's what, aside from the long stop dates, also called a drop dead date. So if the transaction doesn't close within a given date and it's not extended, then the parties, or one of the parties or both the parties, have the right to walk away. So that offers the investors some added protection. Obviously, that's not something that the seller in this current market wants, but that's something in there to protect the investor. For regulatory changes, again, the government, looking at the situation that COVID has created, has started liberalizing some of the ownership laws to allow for ownership of condo hotels, increasing the threshold for foreigners to own certain properties. So that's a very promising sign. And of course, post-merger integration with COVID, look, even if you acquire, you want to put your people in place, it's going to take time. It will take time, and we don't know how long it's going to take with border closures and lockdowns still in place. So I just want to highlight those sort of key areas for sort of M&A transactions in this space, and that concludes our presentation. So I'll hand it over back to you, Winnie.
Thank you so much, Ben. Sorry to interrupt you. Now that we are thoroughly scared into hiring the professionals to get ourselves ready, I hope to hear something positive from Govinder. Mr. Govinder Singh, Executive Director of Colliers International Asia, is considered an expert in the industry within the region. He will take us through investing in Vietnam's hospitality sector pre and post COVID-19 considerations. I'm really waiting for some good news. Govinder has 17 years of experience in the area, and his expertise includes projects in the entertainment, attractions, MICE, theme parks, second home, and wider commercial real estate sectors across the Asia-Pac, UK, EMEA, and Americas region. He is one of Colliers' dedicated specialist portfolio advisors and valuers in the region and globally. He has also written a number of published articles and is a frequent speaker and commentator at a number of conferences. His clients include operators, developers, sovereign wealth funds, private equity, REITs, banks, high net worth individuals, government, and institutional investors. Govinder, are you ready with the video and microphone?
Thank you very much, Winnie, for that introduction. I'm just starting the video. Good afternoon, everyone.
We're not seeing you and not seeing your screen yet.
Can you unlock my video, please?
All right, we're seeing you.
Hi, good afternoon, everyone. Thank you very much, Winnie, for that introduction. Hopefully, I will have some good news if I can. Let me share my screen. I've been in this hospitality business for over 20 years, 17 of which was really carving my network across the world. And I must say, this situation is quite unprecedented. I've never come across this where we're in a situation where we have both demand and supply impact. We have travel restrictions. Normally when we have a downturn, it would tend to be more on the economic side. But if memory serves me correctly, I believe it's 1918, when it was the Spanish flu, that we had all the travel restrictions that we currently have in place. The good news is, as we can see from the Vietnam Hotels KPIs, there are some green shoots ahead, and there is some recovery forecasted. But perhaps I take you through what's been happening over the last few months. A lot of people would say, well, what can we equate this crisis back to? And would they bring new trends? As I always say to people, crises don't create trends, it just accelerate them. You know, using of technology was already coming on stream, just a little bit slower, but now it will be accelerated across hotels, for example. Now, looking back at the data and comparing what's been happening over the last 5 months versus SARS, will it be SARS 2.0? The answer is clearly no. You know, SARS impacted a few countries which went into lockdown, but to the extent that it was not as much as we have now. The SARS, as soon as the epidemic is under control, as you can see, it bounced back within 3 to 6 months. It is likely in this scenario that we were looking at a much longer time window in a recovery time frame, and a lot of it is because of the disjoint in how the different markets, the different destinations have been, and the timeline that these countries have been impacted by COVID-19. So, for example, you know, this all started in China, whether it's October or February this year is to be debated. But it's now slowly spread to the US. The good news about Asia is that I would say about 85% of travel is intra-Asia. So that's good news. If we can get intra-Asia travel up and running, hotels across Asia will do well. Focusing a bit more on Vietnam, as you can see, a lot of the forecasts, whether it's the IMF or Trade and Economics, forecast pretty much a V-shape recovery for Vietnam, where there's going to be a sharp downturn in 2020, followed by a very fast bounce in 2021, And again in 2022. If you look on the graph on the right-hand side, you will see that the same applies to hotel revenues, for example, where revenues this year is expected to dip by 42% before recovering to 37% next year and another 19% the following year. So it means you will probably be ahead of the 2019 earnings by the time 2022. This is great news, but obviously that depends on a very fluid situation which we have at the moment. I know, we heard this week the EU is opening its borders. Vietnam is on one of those green lists. The UK is opening, and South Korea has a second wave, but things are getting back under control. So it's all comes down to what are the key source markets for Vietnam, and if we can have some green corridor or air corridor, shall we say, where there's reciprocal non-quarantine, I believe the combination of that strong domestic Vietnam market plus some international will push back those numbers very rapidly upwards. Vietnam has been increasingly a must-see destination, and with all the easing of the visa restrictions, that's been great news for tourism arrivals. So you can see that's when the date in 2015, when the visa restrictions were eased in Vietnam, you had this huge climb in international visitation. We would expect the same. So Vietnam still has a lot of runway. I know they've eased their visa restrictions again recently, but there's still a long way to go if you compare it to places like Singapore or Thailand, for example. So there's still a lot of headroom in terms of policy to encourage tourism arrivals. You can see from the graph, we are
sorry to interrupt, Govinder.
Sure.
Is it possible to put your presentation on the projection mode so that we can see a bigger screen?
Sure, I apologize. Is that better?
Yes, thank you.
No problem. In terms of recovery, there's domestic weekend demand will be the first to recover. I believe it's already happening in Vietnam. This will be followed by extended domestic market, and followed by business travel, especially if we get some international air corridors up and going. And long haul will be some time away. I think the preference, especially for Europeans and when the time comes, Americans, to holiday, very long haul, it's going to take a bit of time for that. I think most people want to be within 3-4 hours of their destination. In terms of top picks or destinations, there's no surprise here where we have Phu Quoc, Trang Vang Tao, and Da Nang. Ho Chi Minh City and Hanoi being key commercial and business destinations, and stopover points will always be attractive. So in terms of why invest in Vietnam, there was still a lot of talk earlier about valuations. We will come to that in a minute. But whether the valuations are higher or lower, if you look at the yield spreads, and this is what makes Vietnam such an attractive proposition to funds and institutional investors, is those yield spreads. And historically, you look at the yield spreads, they've been 5% plus on bonds, and that is not in too many countries that have stable policies that can offer those kind of returns. So hence we're seeing a lot of funds chasing these investments, because if funds, especially REITs, are promising their investors 6% returns, they can be buying at 3-4%. They have to be looking at 6% yields plus. We do see yields this year, no surprises, widening, but I think that's a temporary, and as soon as we start seeing upward shift, we will get those yields compressing again. The funny situation that we have now is not that there's a lack of liquidity in the market. There's tons of money in the market. Bond yields are going lower and lower, even in Vietnam. In certain countries, it's negative in a lot of countries. So there's liquidity out there. Speaking to Blackstone this morning, for example, and they're sitting on a lot of cash that they're willing to invest in markets. So there's liquidity, but as I said, the issue here is people can't get to places to do due diligence. Of course, in every crisis, you're going to have some fallout, but it's normally those properties that shouldn't have been operating anyway during the good times. Who's been buying in Vietnam, and will this change? unlikely this will change in the near term, especially when it comes because of the capital restrictions and the compliance that's needed. But I believe if those are reduced, then we'll see more interest. The recently signed EU agreement will provide some impetus from European investors into Vietnam. So we will, I think we'll continue to see cross-border REITs and funds, especially from Singapore and Japan, and to some degree South Korea, really looking at Vietnam. We should have some Chinese and Taiwanese capital in there too, but that wouldn't be as much as the others. Private, high net worth and family office will also be looking at these markets, but private buyers and sellers tend to be more local. Just quickly ending on where we see investment trends. As you can see, hotel volume has been very, very high up until the start of 2020, just pre-COVID. And we like to, beyond that, or post-COVID, I would like to think now that's going to come back very quickly. I mean, already we're talking to a lot of funds, as I mentioned earlier, on potential asset sales. The good news is no one is looking at 25% discount unless it's distress. I think people are being sensible. Of course, there's going to be a price adjustment, but that bid-ask gap still remains substantial in the short term. So it's all going to come down to timing and pricing as with any other investment cycle. Thank you. Back to Winnie, please.
Thank you, Govinder. Thank you for balancing the opportunity with the complexity that KPMG is trying to scare us about. Well, this should be the most interesting part where I'm bringing on Mr. David Jackson, CEO of Capitalise Vietnam and Cambodia, who will moderate our panel discussion. David is a Vietnam-savvy real estate and investment professional and advisor relocating from the UK in 2007 to Vietnam and is the RICS representative here. Now, if I can bring all the speakers to life with the video and microphone. Hello, David. Hello, Ben. Hello, Giovanni. If you just turn on your microphone, I'm going to hand it over to David and take away. You have a maximum of 15 minutes to make these gentlemen very afraid by telling you all the truth that we need to know at this very difficult time. Gentlemen, over to you.
Firstly, thanks very much, Winnie, and thanks so much the Hong Kong Business Association Vietnam for allowing me to chair this Q&A session. Some really, really interesting topic today. We're very active in the hotel market and obviously some wealth of experience with KPMG Legal and colleagues with Govinder. First of all, look, there's some really interesting topics there. Obviously, we're in strange times. Before I sort of move on to the sort of the way the business is going, can I just ask KPMG in terms of, you know, the opportunities a bit later, but first of all, just if you're a hotel owner or a hotel operator, you know, COVID obviously posing significant issues related mainly to cash flow, related to tourism, occupancy. You know, for those sort of businesses, you know, where insolvency might be imminent or it might be happening, you know, what could be taken to mitigate the risks from that? And I guess following that, Govinder, if it's the same in the region. So first to Giovanni or Vin, you know, insolvency, what can hotels do?
So yeah, I mean, what we're seeing now in the market is a lot of hotel owners and operators being a bit creative. And again, it's just replicating what's being done overseas. You know, they have basically, you can buy vouchers, you can buy vacation packages that you can spend sort of many months from now. You know, there are a lot of promotions in place, steep discounts, again, to really increase domestic tourism, just to, you know, make sure that there's basically stable cash flow to keep these hotels sort of operating and then alive, essentially. And we're seeing a huge increase in domestic travel in the past month or so, and I think that trend will continue. Again, it's about being creative in terms of offering products to customers on the sort of expense side. Yeah, I mean, unfortunately, you are seeing a lot of hotels reducing headcount as a way to reduce costs. Again, talking with lenders to reduce payments or interest. So I mean, there are a combination of things, and it really depends on the owner and the operator.
Yes, in terms of mitigating, for example, another cost-cutting measure that hotels are taking into account is change the supply chain, because obviously even in terms of supply for the hotel and these kind of things, everything has become more expensive and more difficult to obtain. So we've seen cuts also in that sectors and renegotiating supply agreements and so on and so forth.
And Govinda, anything to comment on that, or is it the same that you see in the region?
Yeah, but I didn't get the question.
So I'm just saying, for those that are currently in business at the moment in hotels, looking at business insolvency ahead, maybe, are there any steps that can be taken to mitigate their risks or prepare for the future, apart from just cutting staff?
Yeah, at the moment, I think in the wider Asia region, we are seeing still some investment interest. I think everyone is in a wait and see mode. It's what I call frozen market in effect, and we'll see how things pan out over the next few months.
Okay, so again, this question aimed at both of you, but maybe with different angles on it. Giovanni started his presentation this afternoon saying that valuations going down 25 to 30%. The comments, buyer's market has been used quite a few times, but in reality, when transactions maybe take a year and a half, a bit longer, are there bargains to be had, or are the people still holding back and waiting for a higher revenue, or are people going to come into this market and
That's a good point. That's a good point, and that's why we were stressing the timing is an issue, because you have a buyer that wants to close the deal as soon as possible, but you have a seller that is probably, if he's not in a really dire financial condition, he will try to postpone, or he will try to put some provision between signing the deal and closing. So if the valuation, if the market picks up, then the valuation might go up. So we've seen also lots of provision towards that effect, so that if there is any significant change between signing and closing, then the price and the valuation might go up.
Yeah, and just to add to that, I mean, it's very interesting. In terms of the valuation, look, if you have a big war chest and you have provisions to basically address sort of a situation like this, then for those sellers, yeah, I mean, there's not going to be a lot of movement in terms of valuation. But aside from that, we're seeing a lot of sellers. They own and operate a lot of high-end properties. They own and operate a lot of high-end properties throughout the world, and actually, Vietnam is still doing deals. So that's one of the reasons why they're looking for quick cash. Not so much that they want to offload their Vietnam asset. They're offloading because they know it's a good asset. They're buyers, but they need the cash to prop up their other properties overseas.
Yeah.
So that's something we're also seeing, and that's why some of the valuation is affected. But again, the drop really depends on who's selling.
Yeah. Parties can also discuss and agree on deferred considerations, so part of the consideration will be deferred for a number of years also, in the hope that the market picks up, the hotel is producing more revenue, and then the seller will ultimately get a better consideration for the deal.
As you mentioned before, current performance against future projections, does that mean that the deals are becoming a lot more complicated, a lot more lawyers in them, a lot more provisions in case of for the money? Does that mean that pre and post COVID, it's going to be a lot more lawyers and a lot more complicated in transactions. And I'll ask Govinda
Let's hope so. Let's hope so.
I'll ask Govinda before I move to the law firm.
Yeah, listen, I think a lot of people are paying closer attention to due diligence, but what we're certainly seeing is no one is looking at 2020 cash flows. Everyone is saying, you know, it's a write-off. Let's look at what's going to happen, and you know, we have to look at 2021. But the question is 2021 the right year, or is it going to be 2022? So a lot of folks here are looking at it from what we call a normalized or stabilized position. Now, of course, there's going to be some risk in the short term, but we're seeing those long stop dates, for example, being extended to take account of that, and investors asking, you know, vendors to just hold on to the asset that bit much longer.
And I guess now get to KPMG Legal. Obviously, a lot more involvement on both sides with the legal firms. Is that the way you see the future?
Yeah, I mean, our advice is always to have lawyers involved in any transaction, whether it's pre or post COVID. But yeah, I mean, there's a lot of complexity now with COVID, a lot more uncertainty. So that's why, you know, again, we have a few deals where before it was just basically the principals talking with one another, trying to get the deal closed. But then with the, you know, when COVID, you know, appeared, it really slowed things down. So that's why they got advisors involved to really help the process along. And I would have to say it has. So
Yeah.
I would sorry,
please.
I'd slightly disagree. I'd say you always need good consultants, not necessarily good lawyers. So anyway, from my side, again, an open question to both of you. I mean, I've worked with Govinda before on hotel projects, and obviously KPMG Legal, hugely experienced in that as well. You know, I know you touched briefly on it, Dwi and Giovanni, in your presentation, but you know, what are the potential deal breakers when you're looking at purchasing a company or an asset in Vietnam, and I guess in the region, Govinda?
So Govinda, you can go ahead, start first.
Sure. Listen, I don't think the deal breakers have changed very much pre or post COVID. You know, everyone is still going to be doing their legal due diligence, their commercial due diligence, as we call it. And what they might be doing is paying a little bit more attention to the fine print rather than rushing to sign on the dotted line, which is not, you know, no bad thing. And of course, they're asking more details on past performance, because whilst it's no guide to future performance, I think it gives them a very good picture of where a stabilized or normalized set of earnings will come out at. Gentlemen?
Yeah, well, for me, I don't know if I'm too extreme, but probably the potential deal breakers, I see the major deal breaker is the sudden changes in the condition of the asset and the market, in the sense you might have a seller that by the time you sign the deal until closing, the situation deteriorates so much that it goes into insolvency. So you need to have appropriate provision in the draft against this. Or you have an asset and a market situation in which the market picks up dramatically, and then the seller is not willing to sell anymore, for example, or is willing to sell, but there are certain provisions that will heavily reevaluate the deal in all its aspects.
Yeah, I mean, just to pick on Govinda's point, I mean, the deal breakers, you know, 20 years ago and now really hasn't changed much, right? It's basically your title to the assets, the land, the property, your tax obligations, your tax liabilities. You've been operating for 20, 30 years. You know, those are all, you know, potential deal breakers. What we're seeing lately is a lot of properties that have gone onto the market. And the interesting thing is that they've been operating for 30 odd years. So what that is leading to is, for their land use term, it's approaching the end of its cycle. So you basically have a decade, 15 years. So the type of investor that is willing to take on that asset, to take on that risk, right? The deal breaker for some investors, that's a no-go. I mean, unless I have 20 plus years, why make the investment? But for other investors, that's not a deal breaker. That's actually something that they see as a positive, and maybe looking towards the future in terms of regulatory changes. Again, one man's deal breaker is another man's opportunity, as we see it in this market.
Mm-hmm. No, absolutely. But I think in terms for Vietnam, those risks have always been prevalent. That risk of non-renewal or non-extension of that land lease has always been there. So I don't think that's going to change. But you're absolutely right. I think what we're seeing as well is a bit of, as I said, a freeze on deals, because price discovery is tough at the moment. Let's all be honest. Unless you're distressed or you're insolvent, then you've got a different proposition altogether. And even then, banks are saying, hey, you know what? I don't want to just roll this over and get 30% on value. I'm just going to go with the flow, plug some short-term liquidity in it, roll that up into the valuation later on, and then turn it and hold on to it when market starts to turn a little bit. We saw this happen in 07 as well, just after the global. I know it didn't hit Asia as badly as it hit the West, but what we did see is banks willingly come in, say, you know what, we're going to have payment holidays. We're going to convert that into some sort of maybe equity, which banks won't normally want to do. But it's been done before, and I can't see it changing this time around.
Okay, so it sounds as if you have banker cash flow in the hotels, you're trying to look after that or refinance, and an experienced operator with good consulting can come in and kind of look at assets with a long-term view. Let me just touch on one thing, Govinda. I know that we've worked on because we're talking about hotel owners, but the hotel management agreements. And Ben, you also talked about this in terms of looking at the material adverse changes in new contracts. But like you say, a lot of contracts are 30 years old in Vietnam that I've had a look at, and a lot of them have a clause of force majeure in the contract. I know that there was discussions on force majeure a couple of years ago when there were riots here and there was limited tourism from China. Have you heard any talk of that or saying, Govinda, in the region where management operators are trying to get out their obligations with owners because of the current situation?
Sure. One topic at a time. Listen, the HMAs that were signed 20, 25, 30 years ago is not the HMAs of today. Things have moved on, but the fact of the matter is, you're going to sign another 20-year HMA today. So by 20 years from now, it's going to change fundamentally again. What we are seeing is less lease. There's no surprise there. No one wants to commit to rent if they can't pay it. So we're seeing a decrease in lease, and it might be that in a lot of situations where the law allows that, like for example, Germany, you cannot do management agreements. You can only do leases. But for markets where you can do both, we should be seeing more and more HMAs being signed in those situations. Now, the idea of force majeure, I'll let the lawyers deal with. But from what I've been hearing, the Chinese have one version of it, and Americans have a very different view of it.
Yeah, I mean, generally speaking, the HMAs, if you're working with, the global well-known operators, it's generally, very friendly towards them. So like the force majeure, the MAC provision, again, we have experienced this, it's heavily negotiated. And whether the obligation, what obligations are delayed and to whom, again, I mean, that depends on the HMA, but something like this, with the lockdowns, the travel restrictions, basically, if it's an arm's length HMA, owners might have some reprieve in paying certain fees to the operator. So I mean, that is what we're seeing, and based on our discussion with some of our clients, both owners and operators, basically both sides are understanding this is the situation. Let's take a pause and see where we are basically a few months from now, a year from now. So I don't think operators are banging down any doors to say you have to pay my fees, or we're going to terminate, we're going to sue you, because everyone is in this together, unfortunately, or fortunately. So everyone is sort of keeping calm and just working through it as best they can.
Yeah, no, absolutely. I think we're seeing operators are willing to step aside on fees and saying, you know what, we're happy to not step aside, but roll it up later and do a clawback, the famous clawback clause that I don't like when I see HMAs. But you're seeing that. But equally, I think this is an opportunity for both operators and owners to take a realistic view of their relationship and say, you know what, should we say thank you and goodbye here? For HMAs that have break agreements, I don't think there's any there's not going to be a debate that this is certainly unprecedented market conditions. So you can't use that to force them out. Let's put it that way, because everyone tried to say, okay, 2 years performance not hit budget, the usual, let's get you out. I think this clearly falls into that space.
Okay, so look, we're running out of time here, so about to wrap up, but I guess I'll leave it up to Winnie, but if there is any questions that haven't been answered, you've got the best of the best here today, so I'm sure that the Hong Kong Business Association can pass on contacts and contact both of your parties. I'd like to thank you for today, and I'll leave that up with Winnie, but before I go, KPMG, Bin, Giovanni, positive or negative for the future, and I guess the same for Govinda.
I think for us,
always positive.
Always positive. not in the viral sense, just positive in the sense that we are humans, we are very resilient, and we will always bounce back. So I have no doubt it's a matter of timing.
Absolutely.
Absolutely, I share that sentiment. Listen, the wanderlust hasn't departed us. We're still social animals, and travel and having a holidays certainly become part of our DNA recent years. I don't think that's going to change overnight.
Right. Thank you.
All right. Thank you, David. Thank you, Ben. Thank you, Govinda. I'm so happy that this is ending with a positive note. Yes, we're running out of time. We got a couple more questions from the Q&A panels in which we will respond to you privately. And it is a very informative discussion. We will follow up later. A video of this webinar will be available on our website within the next 48 hours, and we will share the slides with you too. Thank you again, Giovanni, Ben, Govinda, and David for sharing your thoughts with us. And to the participants, on behalf of Hkbav, KPMG, and Colliers International, thank you for spending time with us today, and hope you have enjoyed this. Now, if there is a topic you would like to hear about or you would like to be featured in our next webinar, do reach out to us. See you again soon or in person. Until we meet again, thank you very much and goodbye.
Thank you.
Thank you.
Thank you so much.